So, you're your own boss. You've built something from the ground up, you're crushing it, and the money flowing into your business account looks fantastic. You've finally decided it's time to buy your dream home. Maybe something with a great office space or a workshop out back. You march confidently into the bank, ready to get pre-approved, only to walk out feeling like you just got laughed out of the principal's office. The lender took one look at your paperwork and handed you a soul-crushing no, even though you know you make more than enough to cover the payments. What in the world just happened? Welcome to the club, my friend. It's a frustratingly common story for the freelancers, contractors, and small business owners of America. You're not alone in this bizarre twilight zone where earning a great living somehow makes you look like a bigger risk than your cousin who has a steady 9 to 5, but a fraction of your income. It feels completely backward, like trying to explain social media to your grandparents. You work twice as hard, take all the risks, and when it's time for the reward, the system seems designed to shut you out. It's enough to make you want to flip a boardroom table. But here's the good news, it's not you, it's them. Well, sort of. The problem isn't that you're a bad candidate for a mortgage, it's that you're playing a different game than traditional W-2 employees, and the banks are using an old rulebook. To win the mortgage game, you first need to see the field from the lender's perspective. Let's put on our imaginary banker goggles. When a traditional employee, let's call him Salaried Sam, applies for a loan, the bank's job is simple. They look at his W-2 forms and recent pay stubs. If Sam makes $100,000 a year, the bank sees $100,000 a year. It's clean, it's simple, and it's predictable. The underwriter can check a few boxes, run the numbers, and confidently stamp approved, because Sam's income is as straightforward as a multiplication table. Now, let's look at you, entrepreneur Erica. You also brought in a cool $150,000 in revenue last year. Way more than Sam. But you're smart. You worked with a great accountant who helped you write off every legitimate business expense. Your new laptop, that client dinner, your home office, mileage on your car, and even a portion of your internet bill. After all those deductions, your tax return, the document the bank cares most about, says your net income is only $45,000. When the lender looks at that number, their risk alarm bells start ringing loud and clear. They don't see a savvy business owner. They see someone who might struggle to make a mortgage payment. If you've been rejected for a conventional loan, don't slam the door on your homeownership dreams. You just tried to order from the standard menu, but what you need is to ask for the secret menu of mortgages. These are non-qualified mortgages, or non-QM loans, designed for borrowers with unique financial situations, like you. Lenders who offer these loans are more flexible because they don't have to follow the strict government-backed guidelines. One of the most popular options is the bank statement loan. This is a game changer. Instead of looking at your tax returns, the lender will analyze 12 or 24 months of your personal or business bank statements. They look at your deposits to verify your cash flow and determine your qualifying income from there. If you consistently deposit $15,000 a month into your business account, they can see you have a strong, steady stream of revenue, regardless of what your tax deductions say. Another fantastic tool in the toolbox is a profit and loss only loan. For this one, you don't even need to provide bank statements. Instead, you'll have a certified public accountant prepare and sign off on a profit and loss statement for your business for the last 1 or 2 years. Finally, for those who are cash rich or investors, there are options like asset depletion loans or DSCR loans. An asset depletion loan calculates a monthly income for you based on your liquid assets like stocks, bonds, or savings. A debt service coverage ratio loan is for real estate investors buying an investment property. It qualifies you based on whether the property's expected rental income will cover the mortgage payment, not based on your personal income at all. Buying a home when you're self-employed isn't a solo sport, it's a team event. The two most valuable players on your team are your certified public accountant, your CPA, and a mortgage loan officer who specializes in working with entrepreneurs. Bringing these two professionals together early, I'm talking a year or 2 before you plan to buy, is honestly the single best thing you can do to guarantee a smooth process. Think of them as your offensive and defensive coordinators, drawing up the perfect play to get you into the end zone of homeownership. Your CPA is your financial guru. Their main job is usually to help you pay as little in taxes as legally possible. However, when a mortgage is on the horizon, their strategy needs to change. You need to have a frank conversation with them. Hey, I want to buy a house in 2027. What do we need to do with my 2025 and 2026 tax returns to make my income look as strong as possible? This might mean being less aggressive with your deductions for a year or two. Yes, it could mean a higher tax bill in the short term, but paying an extra few thousand in taxes could be the key to unlocking a $500,000 mortgage. At the same time, your specialized loan officer is your guide through the lending maze. A great loan officer who understands self-employed borrowers won't just tell you no. They'll look at your entire financial picture, your revenue, your expenses, your assets, your credit, and map out a concrete plan. This dream team works together. Your loan officer can tell your CPA exactly what income level you need to hit, and your CPA can figure out the most efficient way to get you there on paper. This proactive approach saves you from the heartbreak of getting denied after you've already fallen in love with a house. Let's be clear, being your own boss is the American dream. You have the freedom, the control, and the potential for unlimited success. The idea that this very ambition could stand in the way of another American dream, owning your own home, is just plain wrong. The truth is, it doesn't have to. With the right knowledge and the right strategy, your entrepreneurial spirit is an asset, not a liability. You've already proven you can handle risk, manage complex finances, and build something of value. The path forward is all about preparation and perspective. Stop thinking like a rejected applicant and start thinking like the CEO of Project Buy My House. Your first step is to find a mortgage professional who speaks your language, someone who gets excited, not scared, when they hear the words self-employed. Ask your network for recommendations. Look for lenders who advertise loans for entrepreneurs and interview them. Find someone who feels like a partner, not a gatekeeper. Next, embrace the planning phase. Work with your new loan officer and your CPA to build a 1 to 2 year runway. Tidy up your bookkeeping, maybe hold off on that huge equipment purchase for a year, and be strategic about your tax deductions. It's a temporary sacrifice for a lifelong asset. While you're doing that, polish your credit score until it shines and build up your savings for a healthy down payment. Every positive step you take makes you a stronger, more irresistible borrower in the eyes of any lender, whether conventional or non-QM. You built your business on a foundation of grit, vision, and relentless problem solving. Apply that same energy here. Don't let a bureaucratic speed bump derail your dream of turning a key in your very own front door. The system may have its quirks, but it's not unbreakable. There are more tools, more options, and more experts available to help self-employed buyers than ever before. So take a deep breath, get the right team in your corner, and go make it happen. You've earned it. Now go and own it.